Hello and welcome to this episode of Equity Sahi Hai, brought to you by Motilal Oswal Asset Management Company. Joining me today is one of India's best known fund managers, someone who has been tracking Indian equities for more than 2 decades. He is currently the executive group vice president and fund manager at Motilal Oswal, Santosh Kumar Singh. Thank you very much, Santosh, for joining me here today. There's so much to discuss with you, but let me start with my first question that you seem to be picking up a lot of small caps in the portfolios that you manage, in the schemes that you manage. So, while there is a lot of good growth that some of these have seen in their prices, at the same time, there are fears that, small caps, and these fears have been there, ever since you and me started our career, that small caps are high risk, and somewhere these fears are correct as well. So could you explain why have you been adopting an approach of small caps in this current situation? As somebody told me that the market cap of the highest small cap is 18,000 crores. So things are very different today than what they were in our time when you thought a small cap was 100, 200 crore market capitalization company.
So thanks, Vivek, for having me here. And it's a great question. Actually, I always get this question from a lot of people, right? That why small caps and why in this particular category and all that stuff, right? So let me first see. I would just before getting into small cap, mid cap, or large cap, right? Let me first take you through the way I pick stocks, because when I'm picking stocks, I'm really not thinking about small, mid, or large cap. Okay, I am thinking about picking a company which actually is able to satisfy my criteria of stock picking. And the basic criteria of my stock picking is that, then it's very simple. We follow QGLP at Motilal Oswal, and within QGLP, right, it's a very simple sort of you can say four-part criteria. And the first one is that every company I pick has to be in a very large segment. Right? Second, the company has to be significant portion of that large segment and most probably market leader in that particular segment. And its growth rate has to be highest in that particular segment. Right? The third criteria, which is very important for me, that I don't like to buy companies at any prices. I like to buy companies where my PEG is less than 1. So if you look at most of the companies which I buy, at the time of buying, my PEG is around 0.5. Not for all, but for most of the companies. And finally, see, I don't like to buy companies where there is any corporate governance risk going forward. Right? So these are the four basic criteria which I sort of choose to buy my companies. Actually, you remain in a small cap index only if you keep on losing. Otherwise, in 5-10 years, you move to a mid cap index or eventually to a large cap index. Right? So if you are investing in a small cap index, I have my worries. Right? It's a loser's index. Every time the performance also tells you it's very, very patchy. Now, within that, you're trying to find out, and as I said, I don't care about small, large, or mid. Okay. While buying the stocks, and if you look at the stocks which we are talking about, right, out of total 24 stocks, I have got 4 small cap in my portfolio. Okay. It's the allocation which is large, but actually out of 24, there are 4 small caps in this portfolio. Now, if you look at every small cap, those are markets. So one of the stocks which I kept always being asked about is that why you have got, say, a Religer Enterprises as one of your top 2 holdings, right? I keep telling people that, okay, so let's, and I'm taking this as an example, not that I don't like to pitch stocks, but I'm just taking it as an example that how it satisfies those 4 criteria. So Religer Enterprises owns a company called as Care Health, right? It is the second largest health insurer in India. And in my view, health insurance is going to be a really, really large market. Globally, it is one of the largest financial sector markets. Okay. So it's one of the largest in that particular space. Second largest, actually. It's highly profitable, growing at around 40%. Right. And when I got it at around 0.25 PEG. So thing is, you can say that, okay, it's a small cap, but it's a 5,000 crore GWP company. If market has decided to keep it a small cap, how do I care? I would rather ride it till the time market makes it a mid cap or a large cap. So for me, the criteria is simple. It's not about small, mid, or large. And then that's why one of it's just around a couple of months back, I was telling someone that, okay, there could be a time when you might be asking me why you don't have any small cap. Because for me, while selecting the stock, I'm not looking at market caps.
And it's interesting that you said that because, while you gave one example, but, there are certain industry leaders, in their respective segment, big companies, which are actually categorized as small caps. So, and this could be across sectors. I mean, if you see.
So that's what. So industry. So see, with small caps, there are two type of companies, which are perpetual problematic companies. One is, see, if you are a small company in a large segment, then you are actually a fragile company. Because if you're a small company in a large segment, then anyone can come and sort of compress your margins, or actually they can also take you out of the business. And second is, you are a large company in a very small segment, right? The niche segment. Actually, I don't like to buy either of the two because these are fragile companies, So I keep saying that I buy fragile stocks, not fragile companies. So these two, this is a fragile company part of the market, which can remain permanently small. And what I buy are the companies. So the second one is in the payment space, right? Payments to me is one of the largest space in India. It's going to be one of the largest space in financial sector in next 10 to 15 years. And if you are in that particular segment, and if you are market leader, then today you can be anything. But in multiple years time, and when you are a market leader, no, you are not worried. Actually, you whatever might be the economic scenario, you are not going to get into trouble. And specifically, if you are profitable. So that way, as I said, it's one can argue that small cap or mid cap, but what I argue is that I buy companies which are not fragile companies. The stocks could be, because the market is not looking at it today, the stocks can be fragile, but the companies are the strongest one in their particular space.
Is that what explains, Santosh, that you made certain changes after you took over both the Balanced Advantage Fund and the Multi-Asset Fund? And they're both doing very well currently. And let's talk about the BAF one first. That typically the industry, on the equity side of BAF keeps bulk of the portfolio in large caps, whereas for reasons that you explained earlier, you have, I think, almost about 40% of your allocation in terms of value, not companies, as you mentioned, it's only 4. In a small cap and category. And has that worked for you because the small caps have seen a surge? What happens when, the small caps are overvalued and we start seeing a correction in them further?
So see, I would answer the second part first and the first part after it. Right? Okay, so as I said, I am not buying the small cap index, right?
Yes.
Okay, I am not buying the small cap index. So, and I'm not actually tied up with any company, So the current allocation to small cap is around 30% of the portfolio. In March also, my allocation to small cap was 30% of the portfolio. And actually that portion of the small caps are actually more than doubled. And the allocation is 30%, which means so there were 4 stocks with 5% weight. Out of that, now 2 stocks are 1.5% weight. So when I find stocks which get expensive, in my view, I book profits. I generally don't look. stay with those companies for a very, very long period of time if I find these stocks being expensive. If the stocks are not expensive in my criteria, then I will hold it up to the time I find that they are going in line. So see, I was a research guy for so many years, and I
Yeah.
only believe in one thing, that you have to care about input. See, and input in a stock market is what you think about the EPS and the company. See, stock price is an output, and I would really say that that's luck. In the near term, in a year's time, it's luck. In 5 years' time, your luck and hard work can sort of coincide and come together. In 10 years, they definitely come together.
Mm.
So focus is on input. It's not on output, that what is the stock price, what's going on there. If my companies are showing 40%, 50% EPS growth, and if the stock moves up 50%, how does it matter? But if my stock is going up by 100% and EPS by 15%, I would rather sell all my position and get out of it.
Mm.
Okay. So if you are looking at the portfolio, and I keep analyzing it every month, because I thought maybe that what is the EPS growth which is happening, what is the EPS growth which is expected, because this is in my hand. Stock prices, market will do whatever they want to on the stock prices front. So it's not in my hand, and I don't lose my sleep over that. So that's one first part of the equation. Secondly, see, balance advantage, we actually filed, I think, more than 10 or 15 SID changes from last year. And the reason we did that was, it was not that there was anything wrong with the portfolio. The reason some of the changes which we made was more because we wanted more flexibility with our balance advantage fund. Right? Because, see, we change our equity allocation based on our proprietary sort of quant model, which is called MOVI. Right? And our MOVI was filed with the regulator and with no flexibility, if at all, with the fund manager. And I have realized, see, whatever in my life, whenever I've started doing things, in the first instance, it was always gone wrong. Okay. I've always started with some bad timing only. Say I started my career in 2002-3 when the sort of tech bubble burst, and I know how hard it was to find a job. I started my equity career in 2008. I started and financial crisis happened. I took BAF in January of 2022, and I took BAF, and actually Putin decided that this is not the right time for you to get BAF. Right? So thing is that, see, why I'm saying that is MOVI, when you file it, and if you have no flexibility, then if and it's a very, very good sort of quant model, but what it prices in is all the data, right, which is based on the past. It doesn't take into account what the events which are happening today or which will have an impact in the future. Right? So the first impact happened in February, wherein we were sitting at very high equity position, and suddenly Putin decided to do whatever he did, and everyone changed to a lower equity position. We were not able to. Right? So we thought that, okay, we need flexibility, although we need to be very transparent on how we do things, and we will keep MOVI filed with the regulators, but we will need transparency. So that was one big SID change with it. Then the other changes we did was around, and one of the things that was, we changed the name actually from dynamic to balance advantage, more because balance advantage is known, the category is known as now as balance advantage and not as dynamic. But other changes were smaller ones, right? We wanted, because of ILFS, we decided that we will not do anything less than AAA. And we said, okay, fine, we are QGLP house on equity, we will be QGLP on debt. Okay, so that was another thing. We said that, okay, we will do up to AA, but we are not going below that. But just remaining in AAA is not going to give you anything. Okay. So that was the another change. So we are not taking any credit calls at all. But we said up to AA, there has to be some yield also up to AA, right? It's not that you can make all the money out of treasury or AAA only. So on the bond side, we decided that we need to be more active with following the QGLP criteria, doing all our research by ourselves also. On arbitrage also, we changed a little bit, because earlier we were very passive on arbitrage, where we were hedging, which was a stock-to-stock hedging. We moved to a more active hedging strategy, which helped us over a period of time. because eventually the category is all about not capturing the downside also, and we captured a lot of downside in February when we were not able to actually move anywhere. So we captured a good amount of downside then. So we decided that we need to do some fundamental changes, and we did that. So all those changes we did, and so that's around it.
In fact, it's interesting, Santosh, the points that you're making. And, because if we see the small cap index is, say, 250 companies.
Yeah.
And if one looks at the universe of small cap, I mean, even if we exclude half of that universe, we are still talking 2,500 odd companies. And therefore, as you rightly said, in that category, the index may not necessarily reflect. And that is where the role of active fund managers like you comes in, where you are actually looking beyond those 250, including those, but also looking beyond to see how you can pick stocks, which may not be the case with large cap because, you have a 100 stock universe and 50 are anyway part of the index. So my next question to you is that, you did talk about how you pick a company, but how do you manage the risk? And if I may add one more point, it is that what I heard you, which I found really interesting, is that, and in fact, you do it in both your funds, isn't it? Whether you look at balanced advantage or multi-asset, is asset allocation. And you talked about how you maintained the allocation at 30 and adjusted the portfolio depending on the way prices moved. And that is actually what all the pundits say about the market pundits, about how asset allocation is so important. So if you could touch upon these two issues for me, please.
See, so I'd come to the risk part first, because I think that's where a lot of people have concerns when when you see some small caps or anything like that, right? So I'll come to the risk management part first. Okay, so see, to me, firstly, I'll go back a little bit to your last question and then come back to this part, because you pointed out that actually most of the market participants do it in large cap because that's supposed to be lesser beta. The way we actually, this is one thing which I've seen, that everyone talks about risk from a beta point of view, standard deviation point of view, right? That standard deviation is the only way to measure beta, only way to measure risk, right? But standard deviation is all about where you moved up or down. Eventually, where you go from there, it doesn't capture that. The company can die also. So that is also a risk. It's not that a company has fallen 20% and again come back 20%. So 20% downfall is a risk and 50% uptrend is not a risk. So thing is, that's how we measure. Standard deviation is one of the key measures how you're looking at the risk part. And that's why a lot of people do large caps. My view is that, see, I have the fund mandate is that equity is flexi cap. And if equity is flexi cap, then my view, I'm not doing a great justice by being very passive on the equity allocation and only managing the only managing the returns through asset allocation. My job is threefold. My job is, at the first instance, asset allocation; second instance, within equity sector allocation; and third instance, within the sectors, the stock allocation. And for me, all three are active. We play every part of it active, because I think this is the mandate, because eventually the customers who have given you money, they want returns, right? And they are paying for it. So they're not paying you for running a passive equity fund and active asset allocation fund. I don't think they're running. They're paying you to run an active asset allocation and an active equity allocation, right? This is what they're paying for. So they should get what they're paying for. So this is my view. Maybe everyone has a view, and their views can be different. So that's first part.
Sure.
Now, if I look at the asset allocation part, the way we manage it, as I told you, we have a proprietary index called model, right? So that is a quant model which we have actually devised, and it works very beautifully. It takes into account the price to book, price to earning, and dividend yield, and based on that, it comes out with the right equity allocation at that point of view. Now, what we do is, now with the flexibility, we overlay it with the sort of because it's all backward looking, right? Because all this data is backward looking. You can't have a forward-looking price to book, price to earning because it won't be right. So this data is backward-looking. Now, what we overlay it with, that if there is an earning momentum, then the stock market is going to do well despite being expensive. So we overlay it with earning momentum. We overlay it with the current geopolitics. And then we decide what should be the right asset allocation. In most of the scenarios, it's quite closer to what movie is saying. But tactically, for a month or two, when we find that the geopolitics or the market momentum is very strong, we might differ from where the movie is. So movie is the key determinant on how we decide on the asset allocation between equity and other asset classes. Now, other asset classes, how we will do it is based on our view on those asset classes. But between equity and other asset classes, this is how we are doing it. Now, so that's the allocation part. Second is the risk management part. See, as I said, we are managing what we do is that at multiple levels, right? The first level is the volatility of your portfolio. At the portfolio volatility level, we always monitor what is the portfolio volatility or what is the beta of my portfolio. And you will find that whatever might be the composition of the portfolio, in no time our beta of the portfolio is exceeded above 1. We have kept the beta below 1 for whatever time period we want. So that what we are clear is that, see, and beta doesn't work daily actually. With the outcomes, if you look at on a 3-month, 6-month basis, it gives you what the beta is supposed to do. But daily basis, it might have a different outcome. But what we make sure is this is the first part, what we try to do. Second, so that's one. Second is the liquidity risk. We actually take that into account quite clearly, that how much liquid, because small cap, when you deal with small caps, liquidity is the biggest risk. I don't think it's unless and until you get into, because you're talking about 5,000 companies, there will be 2,000 of those which are not really good companies. So unless and until you have you are able to find out the right, if you are able to find out the right company, the only risk you are left out with is the liquidity. Right? And so we have actually, last year was an acid test of the fund in managing the liquidity risk, because we had outflows and because of our past experience, we had outflows last year, and we actually were able to manage it without any problems. Right. So liquidity is one risk we manage very clearly. At any point in time, my portfolio, a majority of it can get liquidated in a very short period of time. So that's another part which we quite clearly see. And then the other parts of the risk that see, we have a very good risk management policy in place, and then at all point time we are looking at our exposure limits. Given the fund is small, exposure limits actually don't matter as of today, because whatever we might buy, our exposure limits are way above that. But because the size of the fund, and that's why we are able to take some chunky exposures as well. So we are always looking at the exposure limits. And see, the biggest risk to me comes from the governance framework of those companies, and that's a no-no area to me. So what we never get into that part. Whatever might be the price I get, because I come from insurance background. My first job was an underwriter and a claims person, and we were taught only one thing, that okay, every risk you can take, don't take moral hazard risk, because even if you charge 100 rupee premium for a 100 rupee risk, you will lose money. So if you are getting in the stock market, if something at 1p also, and you think there is 5 times upside, don't buy it if you think there is a governance problem there. So that risk we avoid at the first place. So this is one part. And
how you go about it. Yeah. One final question, Santosh. When you mentioned 2000, around when you started your career, I was a few years before that. We hardly had any money. We didn't have the 500 rupee SIP at that time. We didn't have close to 50 mutual funds. In fact, very few private mutual funds were even around at that time. But yet, when you look back, when you see the last 25-year performance of active funds, many of them have actually delivered more than 20% CAGR during this period. And I think a lot of people from our generation miss that. And, we used to always say that it's the FIIs who came and made money in that growth phase and not the Indian retail investor. And now, of course, things are changing. But my final question, since, you are looking around all the time at companies at different stages of their growth, and probably they will ripen over the next 5, 10, 15 years. Do you believe that an investor who comes in today and stays invested for a long duration. I'm not asking you to predict here what kind of a CAGR can happen, because nobody can predict that. But from what you see happening around you in the universe of companies you are investing in, do you see a strong upside over the next 10, 15, 20 years in some of these good businesses? Of course, some will die also, but there is a fairly large universe of companies who you know by now that could grow very significantly in the next 10, 15 years.
Definitely. See, firstly, the momentum on the GDP. So what we are looking at is almost double-digit nominal GDP growth. Right? Because really what we need to care about is nominal if you are looking, because we look at returns also nominal. So if we are looking at the nominal GDP growth rate, if it is double digit, then you're saying that the market is growing at that particular rate. And now see, if what happens in the market is that the themes or the drivers of the GDP keeps on changing. Because what was there in 2000 to 2010 era or 2002 to 2008 era, those are not the same drivers of the GDP in between 2008 to 14 and 14 to 20. And that may not be going forward also. So the new drivers will have multifold growth than the GDP growth itself. So if you are into the right areas, and then that's the job of a fund manager, right? To be into the areas which are going to be the next driver engine to drive growth in the economy. So the underlying growth is very fast. If you are able to be in the right areas, you can be slightly higher or much higher than what the GDP will do over a 10 to 15-year time span. So I think if one is looking at 10 to 15-year lifespan and one is able to sort of follow the process and be firm to the basics, a good amount of a lot of money can be made through compounding. Only problem is and I keep harping on that always. To the investor, this is not a place where you sort of buy, sell, buy, sell. If you keep on doing that, you make very, very suboptimal return. And so the returns will be a fraction of what the market will make for you. So if we avoid that particular part of the equation, definitely there is a lot of money to be made in the market.
It's been wonderful speaking to you, Santosh. Thank you very much for taking time out, on a trading day and speaking to our viewers. Thank you very much. I look forward to many more conversations with you. Thank you.
Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.